there are two things here, I'm afraid. God, I'm going to sound like an economist. What a horrible idea. On one hand, we have Treasury saying that they will be buying something like 60 billion assets per month. They will work up to about 1 trillion in a year. And that is positive for the market. On the negative side, and I'm afraid I don't buy this very quick recovery, is that this is not a financial crisis. I know it sounds very stupid, but it is a crisis about the real economy. In other words, harking back to the 2008, when the central banks pumped in a lot of money because the United States mortgage market had collapsed. Nothing of the kind has happened here. The concern here is what's going to happen to the real economy. And I'm afraid pumping in more money to support the financial sector does absolutely nothing where the real problem is. Now, poor little old Hong Kong, however much has been criticized, by myself included, they did something quite right. They gave money to the people, 10,000 Hong Kong dollars for all its individual citizens. Look, you know, United States has got 330 million people. If they start giving 1,000 US per month to every single American, okay, within 3 months, they would have done about $1 billion plus, and they will have plenty of money still to come. And this is money that will go straight into consumption. You know, lowering interest rates does absolutely nothing to rupture supply chains. It's as simple as that. That's why I started by telling you good news in the sense that the Fed supports the financial markets. Bad news does nothing absolutely as to what is the core cause of what we're looking at now.
But could it not develop into a financial crisis? We've been talking a lot, particularly on this program over the last week, of course, about the collapse in oil prices. Oil is on track for its worst week since 1991, down by some almost 30%. Isn't that going to have a broader impact? And we've been particularly talking about shale producers in the United States and banking exposure across US financials to the oil sector. And if we see a protracted and prolonged downturn in the oil price, what that is going to mean for the financial viability of some of these companies. And that could be the credit event that potentially sparks something broader than just a health crisis.
Yeah, absolutely. But Matt, look at this. Low oil prices is incredibly good for global inflation. Yeah, that's very, very good. And of course, it's incredibly important for oil consumers. Now, I'm a greenie at heart, so I don't want to see more carbon dioxide being pumped into the atmosphere. But equally, I'm not going to have a bleeding heart for oil producers and oil producers countries in particular. So lowering the oil prices might be bad for oil companies, but it is extremely good.
How do you navigate then the markets as we see them right now? We've been showing, of course, the moves on the volatility index, the VIX up 40% overnight, because the worst one-day decline that we've seen for Wall Street in the overnight session since 1987. So how do you position as an investor in these markets right now?
Very simple. One, I don't buy the dips because here we're going to have more dips. I remember now at the end of February, we had a big dip, then nothing happened for 1 week. And in the last 3 days, we had the worst moves since virtually 1987. Point number two is I am looking at economies that at the time that all this started, about a month ago, were on their uptick. There were a few of those, okay, including Taiwan, for example, possibly Thailand. And they are the ones that are likely to stave off and survive a little bit better the undoubted dip on their GDP growth, precisely because of the disruption in the supply chains and then because of the disruption in all real exchanges. And the third point is I'm not keen at all on even thinking about going into bonds because we are going back slowly into zero interest rates. And I think this is a huge mistake because it only addresses the financial side. It doesn't do anything to address the real side of the economy.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.